welcome to my channel, My Money Saved. So in today's video, we're going to talk about financial literacy. So make sure you understand some of the basic terminology used in personal finance. So let's start with income. So what is income? Income is money that you earn. So it could be in the form of salary, paycheck, or in the form of a business that you operate, investments, so side hustles that you have. So that's income. And then what's net income? Net income is what you take home after taxes and deductions. So you have your paycheck, it will say one amount, but after taxes, what hits your bank account is the net income. Expense. So expense is money that you spend. So a piece of your paycheck goes towards expenses. Two types, we have fixed expense and we have variable expense. So fixed expense is the same amount every month. So like say rent, for instance, insurance is the same every month. But we have variable expense, which changes month to month. So like food, gas. So these will change month to month. And then we have cash flow. So cash flow is income minus expenses is what's left over is cash flow. So positive cash flow is money left over and negative cash flow is like under, so you had more expenses than income, so you had negative cash flow. And net worth, so net worth is what you own minus what you owe. So assets are what you own and liabilities are what you owe. So your debt, car loans are what you owe, liabilities. So asset, something that puts money in your pocket, and liability is something that takes money out of your pocket. And some of the terms regarding debt, so debt is like loan, things that you owe. So we have principal, that's the original amount that you borrowed. So say for your house is 500,000 for example, and say you took a loan for 500,000, so that's the principal. And interest is the cost of borrowing money. So when you bought that house, the bank gave you money, gave you 500,000 for you to buy that house. And so you're gonna pay the bank back 500,000, but the bank's gonna charge you interest. So that's the cost of borrowing 500,000 from the bank, cost of borrowing money, interest. And we have APR. So the bank will charge you APR, which is annual percentage interest. So that's the total cost of a loan, including fees and everything, per year. And then we have minimum payments. So that's the smallest amount required to be paid on a monthly basis. You'll see this on credit cards, minimum payment, but don't fall for that. You have to pay your full balance due, especially credit card, every month because the interest is very high on these. And then we have amortization. So how loan payments are split between principal and interest over time. So that's the amortization. And we have some investment basics. So we have stock. So stock is ownership of a company. So you buy a piece of stock, say Apple stock, Microsoft. She'll buy a piece of the stock. Bond is loan you give to a company or government. Index funds, so like a fund that tracks market index like S&P 500. We have ETFs, so exchange traded funds, so a basket of investments traded like a stock. So ETFs will have like some tech stocks, some home stocks like investment REITs. We'll have some food, oil and gas, so it's like a varied, so ETF, that's a fund. And then we have dividends. So payments companies will give to shareholders. So I will get a dividend if I own a piece of the company. Capital gains are profits from selling an investment at a higher price. So your house, if you bought at a lower price but sold at a higher price, you'll have capital gains. And so capital gains are taxable. So you'll be taxed on that gain. And then we have compound interest, returns on your earnings. That's compound interest. So this is how wealth is created. So you'll have some amount invested, say 10,000 invested, and then on that investment, you'll have compound interest. So you'll gain more money on top of that. So there will be like a percentage of interest that you'll earn. Volatility is how much an investment price moves up and down. Diversification is like spreading investments across different sectors. So like technology, food, oil and gas. So you can diversify your portfolio, they say. And then asset allocation is how you divide investments. So between stocks, bonds, cash in the bank. So asset allocation. And then FIRE and wealth building terms. So we have FIRE, which stands for financial independence, retire early. And so that's building enough investments for you to stop working early. So it will be money, even while you're sleeping, it will make money. So investments will pay you. Coast FIRE is having enough invested that it grows to retirement without any further contributions. Lean FIRE is early retirement with minimal lifestyle expenses. Fat FIRE is like early retirement with high-end lifestyle. So just having how much you want at retirement, whether it's like 60,000 lean or 80,000 fat. So how much you want in return when you retire. And the 4% rule guideline suggests that you can withdraw 4% of your investments annually in retirement. So say if you had 2 million accumulated when you're 60, so taking 4% out, so that would like 80,000 per year. So that could allow you to get money up to like 20 years. Say you live till 80, so you can have money coming in up to that year. And financial independence is when investments cover living expenses. So you don't have to work anymore. Your investments will cover your living expenses in the form of dividends and investment income. And we have some retirement accounts. So know in your country what the retirement accounts are. So in Canada, we have RRSP, we have tax-free savings account, we have RESP. So know the different investment accounts in your country. And some real estate terms. So we have equity. That's the portion of property you truly own. And we have appreciation, which is the increase in property value over time. Cash flow is rental income minus expenses. Leverage, which is using borrowed money to invest. We have just some terms used in personal finance. So we have lifestyle inflation. So that means increasing your spending when your income increases. Opportunity cost is when you give up something by choosing one option over the other. Delayed gratification is waiting now to get the benefits later. And then risk tolerance is how much you can emotionally handle if the market crashes and some volatility happens. Return on investment, gain, that's the amount that you've received on the amount that you've invested. And then we have passive income. So income not tied to active work. So passive income is like amount I make while I'm sleeping. Like I don't have to actively work for it. And then we have active income. Active income is something that I have to work hard to get. So that's like my paycheck. Inflation. So inflation is rising prices that reduces your purchasing power. So $2 today will not be the same as $2 10 years from now. Like things will be more expensive, so that $2 will not buy you the same amount. And then we have insurance. Insurance is protection against financial loss. And then we have liquidity, which is how quickly you can access the money. So more liquid, less liquid. If it's in the bank, you can get it tomorrow. If it's in the stocks, you can get it relatively liquid, like faster. And then we have emergency funds, so 3 to 6 months of expenses saved in cash, readily available. These are some of the terms that you should know and be financially literate, know your finances, be a financial expert, know your personal finances in and out. I hope this video was helpful. Please leave a comment and let me know the things that you learned from this video. And yeah, I'll talk to you in the next video. Bye.